I need to show you something that just happened in the silver market that has dealers scrambling and investors asking questions they should have been asking months ago. Because what we're seeing right now with premiums isn't normal. It's not a seasonal blip. It's not a temporary supply chain hiccup. This is something different. And if you understand what's actually happening beneath the surface, you'll realize we might be watching the early stages of a market dislocation that could reshape precious metals pricing for years to come. Let me paint you a picture of what normal looks like first. In a healthy, functioning silver market, premiums over spot price typically run somewhere between $1.50 to $3 per ounce for standard bullion products. That's your baseline. That's what decades of market history tells us is normal when supply and demand are in relative balance. Dealers need to make money, mints need to cover production costs, and there's always some friction in the system. So you pay a bit over spot. That's how it works. That's how it's always worked. Except right now, we're not seeing $1.50 premiums. We're not even seeing $3 premiums. Walk into a major dealer right now, pull up their website, and you're looking at premiums that have spiked to $7, $8, even $9 over spot on standard American Silver Eagles. Some products are pushing double digits. And here's what makes this absolutely fascinating from a market structure perspective. Spot price hasn't moved dramatically. Silver's been trading in a relatively tight range. So this isn't about the price of silver going up. This is about the premium, that gap between paper price and physical price, suddenly exploding. And that gap is trying to tell us something critical about what's really happening in the physical market versus what the paper market is showing us. Now, I want you to think about what a premium actually represents. It's not arbitrary. It's not dealers just deciding to charge more because they feel like it. A premium is the market's way of expressing the real cost and real availability of physical metal. When premiums spike like this, it means one of two things is happening. Or more likely, both things are happening simultaneously. Either demand for physical silver has surged so dramatically that it's overwhelming available supply, or supply has contracted so severely that even normal demand levels are creating shortages. And right now, we're seeing evidence of both dynamics playing out at the same time, creating this perfect storm that's pushing premiums into territory we haven't seen since the chaos of 2020 and early 2021. Let's talk about the demand side first, because this is where the story gets really interesting. Industrial demand for silver has been climbing steadily, but what's changed recently is the pace and the composition of that demand. Solar panel production alone is consuming silver at rates that would have seemed impossible just 5 years ago. We're talking about an industry that's now using somewhere north of 140 million ounces annually, and that number keeps climbing as countries around the world double down on renewable energy mandates. But here's what most people miss. It's not just that solar is using more silver, it's that the silver going into solar panels is gone. It's not coming back. It's not getting recycled. It's locked into products with 25-year lifespans, effectively removed from the available supply pool permanently. Then you layer on top of that the explosion in electric vehicle production. Every EV uses significantly more silver than a traditional internal combustion vehicle. We're talking about silver in the electrical systems, in the charging infrastructure, in the battery management systems. And as global EV adoption accelerates, driven by both consumer demand and government mandates, that's creating this massive new source of industrial demand that simply didn't exist a decade ago. This isn't speculative demand. This isn't investment demand that can reverse if sentiment changes. This is industrial consumption that's baked into the infrastructure of the energy transition. And it's only going in one direction. But industrial demand is just one piece of the puzzle. What's really fascinating right now is what's happening on the investment side. And this is where the premium spike becomes a leading indicator of something much bigger. Because we're seeing a fundamental shift in investor behavior, a move away from paper silver exposure toward physical metal ownership. And that shift is creating stress in the physical market that the paper market simply cannot reflect accurately. Think about it this way. If you own shares in a silver ETF, you own a claim on silver. You don't own silver. You own a financial product that's supposed to track the price of silver. And for years that was good enough for most investors. The convenience, the liquidity, the ease of trading, it all made paper silver attractive. But something's changed. Maybe it's the banking crisis earlier this year that reminded people that financial claims aren't the same as physical assets. Maybe it's the growing awareness of how the COMEX actually works, how much leverage exists in the paper market. how few people who hold silver futures contracts ever actually take delivery. Maybe it's just a generational shift, with younger investors who grew up watching financial system instability deciding they want to hold real assets, not promises. Whatever the reason, we're seeing this massive rotation from paper to physical, and the physical market isn't equipped to handle it. Here's where it gets technical, but stay with me because this is crucial. The COMEX, the exchange where silver futures trade, operates on a fractional reserve system. For every ounce of physical silver actually sitting in COMEX warehouses, there are multiple claims on that silver in the form of futures contracts. Most of the time, this works fine because most contracts get rolled forward or cash settled. Very few people actually stand for delivery. But what happens when that changes? What happens when a meaningful percentage of contract holders decide they want the actual metal? You get a squeeze. You get premiums spiking because suddenly the physical market has to deliver metal that the paper market assumed would never be claimed. And we're seeing signs that this is exactly what's starting to happen. COMEX registered silver inventories, that's the silver that's actually available for delivery against futures contracts, has been trending down. We're not talking about a catastrophic drain, but we're seeing consistent outflows that suggest someone, or more likely multiple someones, are taking delivery and removing metal from the exchange system. At the same time, we're seeing reports from major dealers about allocation issues, about mints struggling to keep up with demand, about delivery times stretching from days to weeks to months for certain products. Now, let me tell you a story that illustrates exactly what this looks like on the ground. There's a dealer I know, been in the business for 30 years, seen multiple bull markets and bear markets, knows this industry inside and out. He told me something last week that really crystallized what's happening. He said he's got customers who've been buying silver from him for years, steady buyers, nothing crazy, just accumulating over time. And these customers are now calling him multiple times a week, not to buy more, but to check if he has inventory. Because they're hearing from other dealers that products are on back order. They're seeing premiums climbing, and they're worried that if they wait, they won't be able to get metal at any price. That's not normal market behavior. That's not the behavior you see when people are casually diversifying a portfolio. That's the behavior you see when people are genuinely concerned about availability. And here's what makes it a self-fulfilling prophecy. When enough people start worrying about availability, they accelerate their buying, which creates actual availability issues, which drives premiums higher, which makes more people worry about availability. It's a feedback loop, and once it starts, it's very difficult to stop until either prices rise enough to destroy demand or supply increases enough to meet demand. But here's the problem with the supply side of this equation. You can't just turn on a switch and produce more silver. Silver is primarily a byproduct of other mining operations. About 70% of silver production comes from mines that are primarily producing copper, lead, zinc, or gold. Silver is just what comes along for the ride. So if you want to increase silver supply, you can't just open more silver mines. You have to wait for base metal mining to expand, or you have to wait for primary silver mines to come online, and that takes years. We're talking about exploration, permitting, construction, ramp-up. Even in the best-case scenario, you're looking at a 5 to 7 year timeline from discovery to production. And right now, we're not seeing a wave of new silver production coming online. In fact, we're seeing the opposite. We're seeing mature mines depleting. We're seeing ore grades declining, which means you have to process more rock to get the same amount of silver. We're seeing jurisdictional risk increasing in major silver-producing countries, with governments imposing higher taxes, more stringent environmental regulations, and in some cases, outright nationalization threats. All of this adds up to a supply side that's constrained at exactly the moment when demand is accelerating. Now, I want to shift gears for a moment and talk about something that's relevant if you're thinking about precious metals as part of your retirement strategy. If you're sitting on $100,000 or more in traditional retirement accounts, IRAs, 401ks, and you're watching what's happening in the silver market, what's happening with premiums, what's happening with availability, you might be wondering how you can actually get exposure to physical metals within a tax-advantaged structure. I put together a free guide that walks through exactly how Gold IRAs work, how you can move funds from existing retirement accounts into physical precious metals without triggering tax penalties, what the rules are, what the costs look like, all of that. It's in the description below. No obligation, Just information if that's something you're considering as part of your overall strategy. All right, back to what's happening with these premiums, because there's another layer to this that we need to unpack. When you see premiums spiking on retail products, American Silver Eagles, Canadian Maple Leafs, the stuff that individual investors buy, that's one thing. But when you start seeing stress in the wholesale market, in the 1,000-ounce bars that institutions trade, that's when you know something systemic is happening. And we're starting to see exactly that. Wholesale premiums, which normally trade at tiny fractions over spot, have been creeping up. Not to retail levels, but enough that it's noticeable. Enough that it's causing people in the industry to ask questions. Because here's what wholesale premium expansion tells you. It tells you that even the big players, the institutions, the commercial users, are having trouble sourcing metal. When a solar panel manufacturer needs silver for production and they're paying higher premiums to secure supply, that's not speculation. That's not investment demand. That's real economic activity being impacted by physical market tightness. And when you see that happening across multiple sectors simultaneously, industrial users competing with investment demand, competing with strategic accumulation by governments and central banks, you get price discovery breaking down. And that's really what we're witnessing right now. The paper market, the futures market, the market where price is supposedly discovered, is showing one thing. It's showing silver trading in a relatively calm, controlled range. But the physical market, the market where actual metal changes hands, is showing something completely different. It's showing stress. It's showing scarcity. It's showing premiums that suggest the real price of silver, the price you actually have to pay to get metal in your hand, is significantly higher than what the spot price indicates. This disconnect between paper and physical isn't new. We saw it in gold during the chaos of March 2020, when premiums on gold bars spiked to $100 or more over spot. We saw it in silver during the Reddit-driven squeeze in early 2021, when retail premiums went absolutely parabolic. But what's different this time is the persistence. This isn't a short-term panic. This isn't a social media-driven frenzy that burns out in a few weeks. This is a sustained, grinding pressure that's been building for months and shows no signs of letting up. Let me give you some historical context that might help frame what we're seeing. Go back to 2008, during the financial crisis. Silver spot price actually dropped significantly as the crisis unfolded, falling from around $20 to below $9. But here's what's fascinating. Even as the spot price was collapsing, premiums on physical silver were exploding. Dealers couldn't keep inventory. Mints were rationing production. Delivery times stretched to months. Why? Because the paper market was being driven by forced liquidation, by margin calls, by financial stress. But the physical market was being driven by people who understood that financial system instability made physical assets more valuable, not less valuable. We're seeing echoes of that dynamic right now. The paper market is relatively calm. There's no panic in silver futures. But the physical market is showing stress that suggests something deeper is happening. And if history is any guide, these disconnects don't last forever. Eventually, either the paper price has to rise to reflect physical reality, or the physical market has to collapse to match paper pricing. And given the fundamental supply-demand dynamics we're seeing, given the structural deficits, given the industrial demand that's not going away, which direction do you think that resolution is more likely to take? Now let's talk about what this means for the broader precious metals market, because silver doesn't exist in isolation. What happens in silver impacts gold, and vice versa. And right now, we're seeing some interesting divergences between the two metals that might be signaling something important. Gold premiums have been relatively stable. Yes, they're elevated compared to historical norms, but they're not spiking the way silver premiums are. Why? Part of it is market size. The gold market is much larger, much more liquid, with much deeper inventories. It takes more to move the needle in gold, but part of it might also be that silver is the canary in the coal mine. Silver is more volatile, more sensitive to supply-demand imbalances, and often leads gold in both directions. If you look at previous precious metals bull markets, silver often starts moving first. It's more accessible to retail investors because of the lower price point. It has this dual nature as both an industrial metal and a monetary metal, so it catches demand from multiple sources. And it has a smaller market that can move more dramatically on relatively modest capital inflows. So when you see silver premiums spiking while gold remains relatively calm, It might be an early warning signal that broader precious metals demand is building, and it's just showing up in silver first because that's where the market structure is most vulnerable to stress. There's also a psychological component to what's happening that we can't ignore. Premiums are visible. When someone goes to buy silver and sees that they're paying $8 over spot, that's a concrete, tangible signal that something is off. It creates a sense of urgency. It makes people question the spot price. It makes them wonder if the paper market is accurately reflecting reality. And that questioning, that skepticism about paper pricing, can become self-reinforcing. The more people doubt the paper market, the more they want physical metal. The more they want physical metal, the higher premiums go. The higher premiums go, the more people doubt the paper market. We're also seeing this play out in the secondary market in interesting ways. Normally, when someone wants to sell silver back to a dealer, they get somewhere around $1 or $2 under spot. That's the dealer's margin for buying back metal. But right now, some dealers are paying closer to spot, or even small premiums over spot, for certain products. Why? Because they need inventory. Because they have customers waiting to buy, and they can't get enough supply from mints and wholesalers. So they're willing to pay up for secondary market metal just to keep inventory on the shelves. That's not normal. That's not how a well-supplied market operates. In a well-supplied market, dealers have plenty of inventory. They can be selective about what they buy back, and they maintain healthy bid-ask spreads. But when you see bid-ask spreads compressing, when you see dealers aggressively buying back metal, that's a sign of physical tightness that goes beyond just elevated premiums on new production. Now, let's talk about what could change this dynamic, because it's important to understand both sides of the equation. What would it take for premiums to come back down? Well, you'd need one of two things. Either demand would have to fall significantly, or supply would have to increase significantly. On the demand side, you could see investment demand cool if we got some kind of major risk-off event that drove people into cash, or if we saw a sustained bear market in precious metals that destroyed sentiment. But remember, a big chunk of current demand is industrial, and that's not sentiment-driven. Solar panel manufacturers don't stop buying silver because the price went up. They need it for production. So even if investment demand cooled, you'd still have this structural industrial demand supporting the market. On the supply side, you could see mints increase production capacity, but that takes time and capital investment. You could see more secondary market supply come to market if prices rose enough to incentivize selling. But right now, we're not seeing that. People who own physical silver seem content to hold it, which suggests they're not convinced that current prices represent fair value. You could see new mine production come online, but as I mentioned earlier, that's a multi-year process. So in the near term, there's no obvious catalyst for a significant supply increase that would relieve the pressure we're seeing. What's more likely is that we're in the early stages of a repricing event. The physical market is trying to tell the paper market that silver is undervalued relative to actual supply and demand fundamentals. And eventually, that message gets through. It might happen gradually, with spot prices slowly grinding higher as the disconnect becomes too obvious to ignore. Or it might happen suddenly, with some kind of delivery default or exchange rule change that forces a rapid repricing. We don't know the timing or the mechanism, but the direction seems increasingly clear. There's also a geopolitical dimension to this that we need to consider. We're living through a period of significant monetary system change. We're seeing countries actively working to reduce dollar dependence. We're seeing central banks accumulating gold at the fastest pace in decades. We're seeing discussions about commodity-backed currencies, about alternative payment systems, about a multipolar monetary order. And in that context, physical precious metals become more than just investments. They become strategic assets. They become monetary insurance. They become a way to opt out of a system that's increasingly showing signs of stress. And here's what's interesting about silver specifically in that context. It's more accessible than gold. A 1,000-ounce silver bar costs around $30,000 at current prices. A 1,000-ounce gold bar costs over $2 million. So for smaller institutions, for family offices, for high-net-worth individuals who want physical precious metals exposure but don't have the capital to accumulate meaningful gold positions, silver becomes the logical choice. And if we're seeing a broad-based move toward physical precious metals as strategic assets, as monetary insurance, as alternatives to fiat currency, then silver is likely to see disproportionate demand relative to its market size. Let me tell you another story that illustrates this point. I was talking to someone who works in the family office space, managing money for ultra-high net worth families. And he told me that over the past year he's seen a dramatic shift in how these families think about precious metals. It used to be that if they had any precious metals exposure at all, it was through ETFs or mining stocks, financial products, paper claims. But increasingly, they're asking about physical storage. They're asking about allocated accounts. They're asking about taking delivery. And when he asks them why the change, the answer is always some variation of the same thing. They don't trust the financial system the way they used to. They want assets that exist outside the banking system. They want something that can't be frozen or confiscated or devalued by monetary policy. That's a profound shift in mindset. And when you see it happening not just among retail investors, but among sophisticated, wealthy families with access to the best financial advice money can buy, that tells you something important about where we are in the cycle. These aren't people chasing momentum. These aren't people making emotional decisions. These are people who've spent their entire lives building and preserving wealth, and they're making a calculated decision that physical precious metals need to be a meaningful part of their asset allocation. Now, bringing this back to the premium situation, what we're seeing is the physical manifestation of that shift in mindset. When demand for physical metal increases while supply remains constrained, premiums rise. It's basic economics. But what makes this situation particularly interesting is that the premium spike is happening while the spot price remains relatively subdued. That suggests that the paper market hasn't fully absorbed the message that the physical market is sending. And that creates an opportunity, but also a risk. The opportunity is that if you understand what's happening, if you recognize that premiums are a leading indicator of broader price movement, you can position yourself ahead of the crowd. The risk is that if premiums continue to rise while spot remains flat, you're paying more and more for the same amount of metal, and there's no guarantee that spot will eventually catch up. But here's the thing. In every previous instance where we've seen sustained premium expansion in precious metals, it's eventually been followed by spot price appreciation. The physical market leads, and the paper market follows. The timing is uncertain, but the pattern is consistent. So, what does all this mean for someone who's watching this unfold and trying to make sense of it? First, understand that what we're seeing with silver premiums isn't noise. It's signal. It's the market trying to tell you something about underlying supply and demand dynamics that aren't fully reflected in the spot price. Second, recognize that this is likely a process, not an event. Premiums probably aren't going to spike to $20 overnight and then crash back down. This is more likely to be a grinding, persistent pressure that builds over time until something breaks or adjusts. Third, think about what your own goals are. If you're buying silver as a long-term store of value, as insurance against monetary system instability, then paying elevated premiums might be acceptable if you believe the alternative is not being able to get metal at all. But if you're trying to trade around short-term price movements, elevated premiums make that much more difficult because you need a bigger move just to break even. The other thing to consider is product selection. Not all silver products are seeing the same premium expansion. Government-minted coins like American Silver Eagles are seeing the highest premiums because they're the most recognizable, the most liquid, and the most trusted. Generic rounds and bars are seeing lower premiums because they're less desirable to retail investors. So if you're cost-conscious and you're buying for metal content rather than collectability, you might be able to find better value in less popular products. But you also need to understand that when it comes time to sell, those less popular products might have wider bid-ask spreads and might be harder to move quickly. There's also the question of timing. Should you buy now with premiums elevated, or should you wait and hope that premiums come back down? That's a personal decision that depends on your individual circumstances and risk tolerance. But I'll tell you what history suggests. Waiting for perfect conditions usually means missing the opportunity entirely. If you wait for premiums to normalize, you might also be waiting through a significant spot price increase that more than offsets the premium savings. If you wait for a major price correction, you might find that physical availability dries up entirely during the correction, just like it did in 2008 and 2020. The reality is that markets don't give you perfect entry points. They give you information, and you have to make decisions based on incomplete information with uncertain outcomes. What we know right now is that premiums are elevated and rising. We know that physical availability is tightening. We know that industrial demand is strong and growing. We know that investment demand is shifting from paper to physical. We know that supply is constrained and unlikely to increase significantly in the near term. All of that points in one direction. It doesn't tell us exactly when or how the situation resolves, but it tells us that the current equilibrium is unstable and likely to shift. One more thing I want to touch on before we wrap up: the role of sentiment and narrative in all of this. Markets aren't just about supply and demand fundamentals. They're also about stories, about narratives, about what people believe is happening and what they expect to happen next. And right now, the narrative around silver is shifting. It's moving from silver is a volatile commodity that sometimes goes up and sometimes goes down, to silver is a strategic asset in a world of monetary instability and energy transition. That narrative shift matters because it changes how people think about the metal, how they value it, and how they behave in the market. When silver was just a commodity, people would buy on dips and sell on rallies. They'd trade around the price action. They'd treat it like any other speculative position. But when silver becomes a strategic asset, behavior changes. People buy and hold. They accumulate on weakness. They don't sell just because the price went up. They think in terms of years and decades, not days and weeks. And that change in behavior, that shift from trading to accumulating, fundamentally alters market dynamics. It reduces available supply because metal gets locked away in strong hands. It creates persistent demand that doesn't evaporate when prices rise. And it makes the market more prone to supply squeezes and price dislocations.